The upcoming Goldline Pharmaceutical Limited BSE SME IPO presents a sharp calculation for investors. Small and medium enterprise issues offer high reward momentum, but the margin for error is razor thin. Here is the baseline data. The company is raising 11.61 crore rupees entirely through a fresh issue of shares. The subscription window runs from May 12th to May 14th, 2026, with the price band set at 41 to 43 rupees per share. If you were looking at this as an individual retail investor, the entry barrier is steep. You cannot buy a few shares to test the waters. A single application requires a minimum commitment of exactly 2,580,000 rupees. The metrics drawing people to that price tag are compelling. For the 2025 financial year, Goldline reported a return on equity of 35.83%, backed by an EBITDA margin of nearly 21%. In the pharmaceutical sector, those numbers command attention. But those top-line numbers operate alongside serious structural headwinds. The company is carrying a massive load of pending tax litigation, and its daily operations rely entirely on a very tight cluster of external partners. Evaluating an SME IPO requires discarding the mainboard playbook. These are illiquid assets where a single bad quarter can freeze the market, leaving you unable to sell your position regardless of the price. You have to decide if committing over 250,000 rupees is justified by a high-margin, asset-light business model, or if that same model is actually masking deep vulnerabilities you will be left holding. Goldline calls itself asset-light. The company does not manufacture a single drug in-house. Instead, they identify off-patent formulations approved by the CDSCO, contract out the production, and focus strictly on marketing and distributing products across 5 specific brand categories. By skipping the factory floor, Goldline avoids heavy machinery costs, factory payrolls, and direct manufacturing compliance. That lack of capital expenditure is the direct engine behind their impressive 21% profit margins. This map shows their limits. Maharashtra and Madhya Pradesh generate over 70% of total revenue. Fading to their supply chain reveals severe fragility. Goldline sits in the center, entirely reliant on exactly 15 third-party manufacturers and just 8 core distributors. If 2 of those manufacturers fail a quality inspection, or a couple of key distributors negotiate better terms with a competitor, Goldline's product pipeline freezes. They own the brands, but they do not control the physical supply. Management plans to use future cash flow to expand into rural markets by adding more third-party carrying and forwarding agents. To scale revenue, they have to scale their reliance on external partners. Conclusive. A 35% return on equity looks great on paper, but in this specific case, it exists because Goldline outsourced its heaviest operational duties. They haven't eliminated risk, they have simply shifted it to their contractors. So what does Goldline intend to do with the 11.61 crore rupees they are raising from the public? This chart shows out of the 11.61 crore target, a massive 8.35 crore is earmarked immediately for debt repayment. Zooming in on the remainder, only a tiny fraction of your investment is actually left for general corporate purposes. The optimistic read is that retiring 8.35 crore NZ cleans up the balance sheet. Stripping out that heavy interest expense mathematically increases future net profit margins. Bluntly, the practical reality is that retail investors are tying up 2.58 lakh rupees, primarily to bail out old corporate liabilities. You are paying for past expenses, not funding the digital integration or the new product portfolios the company says it wants to build. It is also worth noting the promoter's entry cost. In June 2024, they issued themselves 46 million bonus shares in a 2-to-1 ratio. That accounting move severely diluted their weighted average cost per share, placing them in a highly comfortable position compared to the 41 to 43 rupee premium asked of the public. Because the vast majority of the fresh issue immediately exits the company to pay lenders, this IPO acts as a balance sheet rescue mission rather than a war chest for exponential growth. At the upper price band of 43 rupees, Goldline values itself at a post-IPO price-to-earnings ratio of roughly 14.58. In the current pharmaceutical market, that looks like a steep discount. But the market rarely hands out discounts without a reason. We have to examine the administrative reality of the company. Currently, Goldline is fighting active tax proceedings. They face 2.71 crore rupees in direct tax disputes and another 63 lakh in indirect tax claims. That totals roughly 3.34 crore rupees in potential liabilities. This scale weighs the immediate threat. On one side, Goldline's entire FY25 profit of 2.83 crore rupees. On the other, pending litigation of 3.34 crore. An adverse ruling instantly wipes out more than a full year of net income. Furthermore, the regulatory filings document a history of secretarial lapses. Management has previously delayed filing mandatory electronic forms with the Registrar of Companies and missed deadlines for their GST returns. Failing to file basic tax returns on time points to a lack of internal discipline. When a business operates with zero manufacturing control and relies heavily on complex third-party logistics, administrative rigor is mandatory. Firm. A PE ratio of 14.58 is a dangerous value trap if the underlying management struggles with basic compliance and faces legal liabilities larger than its annual profit. This brings us to the final calculation. You are looking at a 2,058,000 rupee minimum entry into an illiquid market, backing a company that outsources its core operations and uses your cash to pay down debt. This flowchart breaks down who should apply. First is capital tolerance. Do you have 2.58 lakhs in high-risk cash? If no, or if this is core savings, the severe illiquidity makes this an immediate avoid. For those who follow the yes path, we split by strategy. Conservative value investors hunting for clean, long-term fundamentals should look away. The 3.34 crore litigation overhang makes it uninvestable for long-term holding. The aggressive speculator is the only logical match here. If you are willing to gamble on the visually cheap PE ratio and the high return on equity purely to flip the shares on listing momentum, the math might align with your strategy. But understand the environment. In a broader market dip, SME stocks with governance red flags are the first assets investors dump, and finding a buyer at a fair price becomes nearly impossible. Goldline Pharma is a high-stakes momentum play, carrying significant structural baggage.
अगर आपको डेली IPO अपडेट्स, मार्केट न्यूज़ और ट्रेडिंग इनसाइट्स चाहिए तो हमारी व्हाट्सएप कम्युनिटी को ज्वाइन ज़रूर करिए और स्टॉक मार्केट की हर इंपॉर्टेंट अपडेट से कनेक्टेड रहिए।
ट्रेडिंग और इन्वेस्टिंग में मार्केट रिस्क होते हैं। इन्वेस्ट करने से पहले अपने फाइनेंशियल एडवाइजर से सलाह लें।
इन्वेस्टमेंट की सोचें तो ट्रेडिंग जीनी के बारे में सोचें। अपना भविष्य सुरक्षित करें। आज ही अपना डीमैट अकाउंट खोलें।